Time for another stock review, this time Disney. Over the next few minutes, we're going to cover some very important news with Disney. We're going to share with you, of course, we're going to have a look at the website. We're going to have a look at the news. Elon Musk was very much in the news with the CEO. We're going to do a full back test on the stock. We're going to look at the stock with the dividend payout history. Very important on this company, of course. We're going to go through the balance sheet, the inside trading, who's buying, who's selling, you name it. We're going to cover it all on this video in great detail. We're going to start off nice and light for you, and then we're going to get deeper and deeper. Some people say they watch the first few minutes and then go, it's a very basic review. They didn't watch past the first 4 or 5 minutes, and then they get to realize we get more down into the more meat. We do it that way because some people just want some headlines at the beginning, and I like to introduce it as we go. If it's your very first time here, click subscribe and ring the bell. I'm going to provide you with the best, most advanced algorithmic software, which I am partnered with. I'm not sponsored, by the way. They don't pay me to make these reviews. However, they prefer my views than CNBC, Bloomberg, Yahoo Finance. Why? Because they post all of my reviews for the stock on their homepage of their website. They cherry pick the rest. Mine all go on there. So they like my reviews because they are fair, unbiased, real, and they're based upon the facts and the numbers. And using their service, algorithmic software, we can determine whether it's right to buy the stock, whether it's good value, oversold, overbought, who's buying on the inside, who's selling on the inside, what the latest sentiment is, and the balance sheet. All of that we're going to cover right now on this video. And then later on, you'll see my review there on their website. Well, let's get straight into Disney. The very first time we've done Disney, members can request a review and I will do a full review for you. Okay, let's get straight into it. We start nice and simple, as I said, with a basic line chart looking at the overall history of the stock. And as you can see, it recently fell away. They changed the CEO, Bob Iger, who's very much in the news at the moment with Elon Musk. We'll cover that in a minute and why that's important and why it's not important. So we've got the stock is now down again where it was in the region of in 2015. So it's not doing very well at the moment. And I will give you my projections, my thoughts on it, a full profitability score and a solvency score as well later on during the video. Do we need to even say what Walt Disney is? Well, I don't think we do, but perhaps we should. The Walt Disney Company engages in the business of international family entertainment and media enterprises. It owns and operates television and radio production, distribution and broadcasting stations, direct-to-consumer services, amusement parks and hotels. Okay, the CEO is Robert Iger, has recently taken over, and he was hailed at doing a great job. However, it's not all good in the camp, and we're going to look at the news in a minute. 250,000 employees, 225,000. There's 250,000, just about 250,000 employees. Burbank, California is where it's headquarters, and it's been around, of course, since 1923. Good old Walt Disney himself. Now then, if you buy the stock with margin, it's regarded as quite a low-risk stock, 25%. 25% is the lowest, 100% is the highest. It's regarded as relatively low risk. That doesn't mean there's no risk at all. It just means from a margin standpoint, it's the requirement is 25%. So it regards it as low risk. Initial requirement is 50%, however. The market cap is 167. Now, we need to understand the market cap is purely the value of the shares outstanding. It's just the price that people are prepared to pay right now, minute by minute, for what the stock is today. Doesn't mean to say the company is worth 167 billion. It doesn't mean anything like it. It means what the share price value is today. Okay, so always worth noting the market cap. The high today is $92. The 52-week high is 118. So there is some volatility there. Price earnings ratio, 71.97. Now, we need to compare that to others in the sector. I'm not going to do that now. You can do that yourself. I'm going to give you the link to that. And you need to go and compare. Perhaps you want to compare to Netflix, for example, or whoever. Because the price earnings ratio is expensive For what it earns, it's expensive. It's been a lot worse, though, because people will overpay for Disney. Premium products, premium assets, they'll overpay for it, hoping that one day it will grow into the stock price. That is sadly the reality of it. But this is not a good valuation. This is very basic. People just use that as a guide and go, well, it's expensive. Maybe I should buy it because it's expensive. It's good. Or maybe I shouldn't buy it because it's expensive. This is not enough information. We'll provide that in a moment. Now, dividend yield is not showing up. Interesting story with the dividend, and we'll come on to that shortly. It has a not that good past when it comes to dividends, and we're going to share with you why exactly in a moment. Average volume, 11.56. Not huge volume on this stock. Volume today is 4.5, and it's about right because it's 10 a.m. in the morning when we're making this video. You can see the clock just beneath me there. All right, 52-week low, 78, and low today is 91.62. All right, let's move on down and let's have a quick look. We're not looking at the news just yet. We'll come to that in a minute. Analysts at Morningstar, they are pretty up to date. This was November the 30th. They're saying it's a strong buy down here. Remember, though, the reason why I've never seen a Morningstar review on Alpha Spread, and you see all of mine, is because mine are open and honest. A lot of these reviews they have their own reasons to promote a stock, say it's good buy. We see it all the time. You cannot believe all you read. You need to understand the stock yourself. However, mine all will appear on the service. They're saying it's a strong buy at 76% and a hold is 17%. But bearing in mind, this is very basic, and a lot of these analysts are, incentivized to say one thing or another. The allure of Disney parks business is unmatched and will be a continuing profit engine. Well, that's obvious. That's the basic headlines. Disney is probably the number one theme park in the world. It does bring in a lot of money. COVID's obviously behind us. Things are better. They suffered during COVID. However, there's a big war going on between Elon Musk and Bob Iger, and we'll talk about that. There is some relativity to that. Anyway, the Bears say too many streaming platforms now exist. I agree, and I'll explain in detail about that in a minute. And it's questionable whether consumers will be willing to pay high prices or stick with individual services month in and month out. One of the things that I always do when I'm investing is I'm looking for something proprietary, unique. It's why I will not ever buy Netflix. I'm a customer. I'm not an investor. And I'll tell you why. Because people will overbuy it with excitement because it's such a great volatile company, but a bit like AMC, Nvidia, all these kind of things. It's a good business. Of course it is. However, it's not proprietary. It's not unique. Disney perhaps is. Let me explain what I mean. People make movies. People make series of TV, and they put it out, and someone buys the rights and streams it on their service. Anyone could be Netflix. I could be Netflix. What do Netflix actually do? Well, they do make their own series, actually. They do have their own studio, like Disney. But let's be honest, Disney is an actual brand. It's an actual icon. It's an image. Netflix is Hulu, is... oh my God, there's thousands. I can't even think of one right now. There are thousands and thousands of streaming services. I could set up, in fact, I do have my own streaming service. We've actually built our very own streaming service, Live Streamer Cafe. I own my very own streaming service. I could make videos, make films, or people could provide me with their movies and I could stream them on my channel. Anyone can build a streaming service. I have one and it's very successful. But we're not talking about my streaming service today. So Netflix has that, as do many others. But Disney has something different. I don't think Disney's ever going away. It's very unique. However, I only buy proprietary stocks. Apple, for example. Who else is Apple? Nobody. Who else is Google? Who else is Tesla? Who else is Virgin Galactic? Who else is Enphase Energy? Nobody. They're all proprietary, unique, on their own, stand out, and all the rest of it. Disney does that, Netflix doesn't. However, there are so many streaming platforms right now. Where do you go? So there is an argument in the bulls. Let's look at the earnings though. The earnings did dip in Q4 22, rose since then, but now it's kind of going sideways. The company isn't really going anywhere right now, I don't think. And I don't know why anybody would be signing up for more services and paying. So I can see the bull's argument. I know, the uniqueness of Disney, but there is so much competition now. Do you need a Disney streaming service? I don't think so. Do you want to go to the Disney theme park? Yes, maybe you do, but you don't need the Disney streaming service. I don't know. Disney could just make films and sell them to Netflix. They could make films and sell them to me. All right. They could make movies and sell them to Apple TV. The list goes on and on and on. So I don't know. I'm not in the stock right now, full disclosure. Right. Let's see who else is buying this stock. No surprise here. We've got old money. Safe money. And I think the world is changing. The company is great. However, it's got some problems in the future, I think, with the streaming service. Microsoft, obviously, great company, but overbought. Old money, just buys everything. Overbought. I can't buy Microsoft. It's too expensive. Netflix, too expensive. Can't buy Netflix. Anyone come along and be Netflix, right? Apple, very different. Proprietary, unique, however, too expensive. Old money. You can see all the old money here. All the institutional money, the rich money is all plowing into here right now. Starbucks, good company, yes, fair enough. I don't buy Starbucks. I have Coca-Cola. Coca-Cola own Costa Coffee, so obviously I'm into Coca-Cola, not into Starbucks. Amazon, great. Meta, great businesses. Very much though, what was known originally as the FANGs, that's now changed, but it was the FANGs. It's the Mangs now, isn't it? And whatever it is, anyway. But old money, the big names, buy all these stocks, you can't go wrong. I think you can go wrong. You can overpay for anything. And these are all overbought stocks, even though they're good. So Disney is in that club. That's good though, on some respects. It's not got gamblers. It's too expensive for gamblers. Not everyone can access. Not everyone can access fractional shares. Remember, not everyone has the access to that. So it's too expensive for those in Mullen, and we wouldn't want to see that anyway, right? And scam stocks, stuff like that. So it's in bed with the right people. However, it's too expensive. It's as simple as that for what it returns. But we're going to look at the details in a moment. Now, at this point, I like to go into the news, and we're going to have a little bit of news here. And I think it's very important because recently, over the last few days, Walt Disney CEO Iger calls out Elon Musk and Ron DeSantis. The CEO made clear that ex-owner Elon Musk has crossed the line, and he explains why the company must sometimes take political stands. I disagree. Your job is not to take political stands. Your job is a CEO of Disney. Simple as that. You're running a business. You're not a politician. Elon Musk, I have absolute overwhelming appreciation and for what Elon Musk did the other day. I'm not going to use the words, but he was bleeped out. Basically, beep you. I don't need your sponsor. I don't need you to. I don't need your advertisement. If you're trying to manipulate me and blackmail me, you can bugger off, basically. And I got every respect for him. It does mean that X can fail. X can go out of business. He admitted it. Doesn't care. You cannot blackmail with money. He went on to explain the full interview, and I thought if you hear the whole interview, as most haven't done, because if you look at it, it's all over social media, with the little shorts of him going, basically, bleep you to Bob Iger. That's who he was talking to. And a lot of people just watch that, and they either think Elon Musk is great because he said stuff it to the CEO and, some sort of maverick, or they understand what he was saying. They watched the whole interview and actually realize Elon Musk was absolutely right. Absolutely right. He's dead right. I don't think that the CEO and other companies have the power or should have the power to threaten Elon Musk, to tell him, what he should or shouldn't say. If you actually go into it, he didn't actually say anything wrong. He explained the full thing. And I thought Bob Iger and all the others were like throwing the dummies out of the pram, thinking they are bigger than they actually are. Bob Iger, if you're listening to my channel, you are not Walt Disney. Not even close. And I think your comment was very, your attitude is very childish, and you're not there to play silly buggers on X. You are there to, run your company. And I think you've embarrassed it, quite frankly. Bob Iger does not seek out fights. Well, he certainly did. Walt Disney CEO has made clear that he's not looking to make new enemies or do anything that would limit the company's potential audience. Okay, well, let's have a look. Let's read a bit more of this. The two-time Mouse House boss, however, has never been shy about defending his company against attacks. That's reflected in its ongoing, long-standing battle with Florida Governor Ron DeSantis, who stripped Walt Disney of its special district that gave the company governance over the land Disney World sits on. I'm not going to comment on anything political here today, and we're just talking about whether it's right or wrong for what Elon Musk was saying. I'm not going to get into the whole politics with Ron DeSantis and all the rest of it. In that fight, which now includes 2 lawsuits, Iger has said that DeSantis' actions are political retaliation for former Disney CEO Bob Chapek speaking out against the right-wing governor's so-called "don't say gay" legislation. The Disney CEO did not pick that fight. DeSantis clearly did in taking over the formerly Reedy Creek Improvement District, but Iger has strongly fought back. I don't think I want to cover too much more of this. We don't want to get into a big war here. I'm just bringing you the news. I'm really more interested in what he did with Elon Musk, to be honest. The Disney boss took a similar tone toward Elon Musk, the CEO of Tesla and owner of X, formerly Twitter, during his speech at the New York Times Deal Book Summit. Iger was not being confrontational, but he showed that he was also wasn't backing down and would defend Disney's right to speak out on politics when it makes business sense. I disagree. I don't think they should have ever tried to threaten, we're not advertising anymore because Elon Musk said something. I think that's childish, silly, unnecessary, and I have every respect for Elon Musk for saying sodja. If you're going to leave because you don't like a comment I'm making, then maybe I shouldn't go to Disney for a comment you're making. Absolutely ridiculous, and I think I've said enough on it. So let's get into the actual business itself. Disney is a great business. However, it struggled recently with its streaming services. There are too many. It really should just focus on, in my opinion, with making the movies, selling those movies however they do it. They could have them all on Netflix. Don't have to have their own platform. They don't have to. And focus on the brand, focus on the theme parks and the merchandise and everything else around the company. We don't need to go through the website of Disney. It's fantastic. We all know the power of Disney. But we also now need to look at the money, though. Is it an investment? Is it right for you to buy as an investment? Let's have a look. Well, let's go into the numbers. Very, very important. We're going to go through the numbers right now and decide whether it's the right time, if at all, to buy the stock. So let's have a look. Here we go. First of all, we need to go into the intrinsic value. This is not enough, however. This is what some people will use. Morningstar, just go, that's the value. It's not enough, and I'll explain why in a moment. Best case scenario. With inflation low, bearing in mind, interest rates are all-time, some historic highs. They are coming down, but remember, the market is 6 months, 12 months ahead of the economy. even though I've said, and I stand by what I've said for a year, I called the bull market. We are in a bull market. I called it 6 months before the banks, Bank of America particularly. I also called the rates will be coming down in the spring and the summer. I called that ahead of everybody else. I stand by that. I still stand by that. It's clear to me that's what's happening. If you look at the numbers and you don't read the false information, that is clearly what's happening. But the economy is 6 to 12 months behind. The people that pay the streaming services, the people that go to Disney and spend money are up to their eyeballs in debt, and that will continue for another year, at least. So we're not in a best case at all. Absolutely not. Are we in a base case? A base case. Well, let's get one thing straight. From where we are right now, Disney is a growth stock. Even though we've got a dividend to talk about now, it doesn't have a great dividend history. We'll talk about it in a moment. It's a growth stock because it was oversold. Perhaps COVID brought it down. Other things like streaming services, whatever. And now the negative news, the fight between Elon Musk and Bob Iger. Base case, I'm prepared to pay 25% overvaluation on a high growth, a great company. Here, it's undervalued by 25%. That looks good. That looks good. Even on the worst case scenario, 7%. However, everything now, other than really beat up stocks, Virgin Galactic, Enphase Energy, Plug, they are the ones, Coca-Cola, J&J, they're all the ones that were cheap. I bought those. This could be, you'd just be better off buying the S&P. I don't know if this has reached the bottom yet. Got to be very careful. You can get what's called a valuation trap and think, oh, it's really cheap. But it looks pretty good, but I'm looking for the best deal. And if I don't get the best deal, I don't buy. I don't just buy on the way down. I don't buy on the way up. I don't just buy because it's a little bit cheaper than it used to be. I go all in when the stock's right. J&J, Coca-Cola, I bought the bottom. Virgin Galactic, Enphase, all of those, I bought the bottom. That's why my portfolio is strong. I buy the bottom and I buy all in when I feel it's the right time. Let's have a look at the historic valuation. 40% profit, current valuation 25%, price and value correlation 10%, and the value of the CAGR 5%. Right now, it seems a good value. We need to explain that, though. Sometimes valuation could be better when the price is high as well. Maybe better news around the stock doesn't necessarily mean now is the best time because the price is lower than it's been for a while. In this particular case, it looks like it does, but it doesn't mean it's the best option for me. And remember, if I'm buying Disney, I could be buying something else. So how does it compare? Let's carry on. Now then, one of our new features on our software is we can find out the key points from the last earnings, and the AI picks up those key phrases and puts them into a statement, which we can summarize the whole earnings report and then value the stock that way as well. This is very important. Let me read this to you. Disney's Q4 results showcase substantial growth and efficiency improvements across its segment, with adjusted EPS nearly tripling and operating income increasing significantly over the previous year. But that wouldn't be hard to do because of COVID. Efficiencies, different. A 7.5 billion cost reduction surpasses the original target of 2 billion. We like that. Contributing to 1.4 billion improvement in combined streaming business results from fiscal 22 to 23. Disney Plus added 7 million subscribers in Q4, with a future focus on 4 key areas: streaming profitability, ESPN's digital transformation, film studio economics, and growth in the experiences business. Operating income for entertainment, sports, and experiences grew notably, and strategic investments are planned to further bolster the experiences division. Fiscal 23 revenue and operating income both grew by high single-digit percentages, and a free cash flow is set to approach pre-COVID levels by 2024. Disney Plus aims for profitability in Q4 fiscal 24 as the company continues to optimize streaming services, with upcoming subscriber growth expected despite an anticipated temporary decline in fiscal Q1 due to recent price increases. Now that sounds quite good. However, here's a bit of inside information. It's not inside information really, but it is research and noting everything and writing everything down and knowing what we saw this morning with Virgin Galactic manipulation, breaking news at certain points to drive the stock down so people could buy it back in again. The whole game is rigged. The whole thing is a game. But like a game of snakes and ladders, you win if you know the rules. If you don't, then you'll always lose, right? Some of that information sounded quite good, but we want to make it absolutely clear. There's a bit of manipulation there. And I'm going to explain why. Sounds great. Revenue up, saving costs, blah, blah, blah. Let's buy the stock. Let's buy Disney. It's great. It's saving all this money. It's going to make more money. It's great, great. Love it. COVID's over. Everyone's going back. Hang on a second. Disney and other film companies actually made money, I think, a quarter or 2 quarters ago, due in large amounts due to the strike, because they were saving money from paying everybody wages. They were all on strike. So there's a lot of information, and I'm not going to go into all the numbers now. You need to do that yourself. A lot of money was saved in a period where that we were in a downturn, when the company didn't have to pay all these wages for all these people on strike. And actually, a lot of companies actually made money the fact their employees were on strike. The poor person, the average man on the street, lost all his money. The people that were providing the catering services, the souvenir shops, selling ice creams down at Mr. and Mrs. Uncle Smith, whatever, ice cream shop in the town. People weren't having ice creams. They weren't staying in hotels, whatever was going on. The small man was losing money when those strikes were happening for the company, for the big film companies. However, the big companies are going, this is great. We're not doing much business right now, and now everybody's on strike. We're saving loads of money here. Fantastic. And they were able to trim back and become more efficient. So the headlines is Disney's becoming more efficient. In fact, a bunch of people went on strike and they saved a load of money. And the headlines is we saved a load of money. When in fact, it wasn't having anything to do with them being really efficient and Bob Iger being a great CEO. It is in fact to do with the fact that everyone's on strike and or part of that. So again, not in whole, but part. Need to take that on balance. Disney wanted to sound like everything is great. However, and there are some good stories in there. However, there were some negative stuff that in there. And actually, we need to remember a lot of very small mom and pop businesses went bust when all those rich superstars were on strike, and their businesses were completely destroyed and may never recover. So the full picture is always very different than the headlines. Just thought I'd add that. My own personal experience of doing my own research on it externally of this review. Anyway, the financials, let's look at it now. Now, the current range, 88.98 billion, it's up at 1%. Yeah, great. Whatever, it's up. But if we look at the chart and we see Disney's growth, and then everything fell off, of course, 2020, of course, COVID, it's hardly made it back. So the CEO, Bob Iger, is taking all this credit for saving the company and saving money when in fact it was mainly to do with strikes. And now the company's growing. Well, it's only kind of getting back to where it was. Again, the reality, we're up 1%. Okay, great. So is it great to buy it now? Is it? I don't know. We'll come on to that in a minute. Operating income. Well, operating income fell off a cliff. Obviously it did. And it's gone back, but it's not gone back anywhere near. And it certainly isn't growing. Now, as an investor, I am not joining fan clubs. I'm not emotionally affected by the stock. I only emotionally am inspired by my audience and you guys watching me live every day. You are my priority. Giving you the real information is my interest, not the stock or anything else in between. This has recovered. The time to have bought Disney was there. I don't know if it's there now, and Bob Iger telling you everything's great. I don't agree, actually, that it's doing that well. It's just kind of continuing where it left off. It's not booming, though, is it? And I'm looking as an investor to find a stock that's got some growth, particularly as we have a very checkered past when it comes to dividends, and we're going to come on to that in a minute. 2.4 billion net income. You can see how it dropped off. I mean, this is all obvious. And the park closed down. It's obvious, right? It's up 5%. Okay, good. Operating cash flow fell away. Now improving. Yeah, great. Nothing that great though, considering. Capital expenditure. They're spending more money investing. That's good. If you're investing in the company to make it more profitable and more efficient, good. If you're just going on headlines, though, you just heard it announced that they're saving money and they're more efficient, and let's give Bob Iger an Oscar. And in fact, they're spending more at the moment, and that's increased by 5%. So I don't know where the efficiencies have come from, but we'll come on to the margins in a moment. Free cash flow is improving by 72%. No surprise, the parks are fully open now, things are back up and running, but is it back up to where it was, and is it ahead? As an investor, I want to know it's going to grow, not just go back to where it was. I mean, what's the point of that? Anyway, I might just buy the S&P and be done with it, right? I don't need the drama. Okay, let's look at the balance sheet. Now, we did a poll on our channel at 95% of people. No, tell a lie. I think it was 85%. I beg your pardon. 85% of people never read the balance sheet. 85% of our viewers, retail investors, never read the balance sheet, just buy everything and whatever because it sounds good. If you don't read the balance sheet, what the hell? You've got no place investing. Right, 206 billion in assets. We do not want to see more liabilities than assets, obviously, and we certainly don't want to see 80-90%, ideally. Here, very, very good, but we need to look at the long-term debt. That's what's important. 206 billion, 106 billion liabilities, great. Balance sheet looks good. What's their liabilities? Long-term debt makes up half of their liabilities. That's not good. It's good that 50% is liabilities. They've got a low level of liabilities in relationship to their assets. The balance sheet is good if the liabilities were predominantly investing in capital, infrastructure, building out, making the company more profitable, building out the business. It's long-term debt. Long-term debt is half of their liabilities. So their liabilities aren't made up primarily of capital expenses, long-term debt. I don't like to see that. Now, that makes up 39% of their liabilities is long-term debt. Had historic highs with the rates. Going to come down, going to improve, but we've got a year away before we see real growth with Disney, purely on the debt basis alone. So again, the right time to buy this was during COVID, right? That's when it was cheap. I don't know if it's cheap now. I think it's okay. I think Bob Iger is trying to take credit for efficiencies that don't really exist, that were mainly to do with strikes, and long-term debt is huge. It's half of your liabilities. I don't know what we're really celebrating. As an investor, I'm looking for a great deal. I don't see a great deal so far. So far, I don't see a great deal. Margins, gross margins, 10%, they're shrinking. Bob Iger has just told you that we're improving efficiencies. Okay, well, We're now down to we're now down to 10%. We were higher. We were at 46%, 40%, 33%. We're now down at 10% gross margin. Margins are going through the floor. Not going through the roof, going through the floor. They're going down. Margins are going down. Now, they are spending capital investment, of course. They are making some capital investments, so the margins will go down. But a 10% margin is no margin. They can easily be not replaced as in the Disney parks. No one's going to suddenly do a new Disney, right? But streaming services, stuff like that, others can wipe the floor. When you've got a 10% margin, you've got no margin, operating margin, net margin. So I don't know about the improvement of efficiencies. I don't really see anything. I mean, there's some return on equity has improved slightly from negative back in COVID period, but I mean, it should. I mean, obviously, I mean, it wouldn't be hard to save money, would it? You open the park, you got money coming in rather than just spending it. So I don't think that's great. I mean, you don't take credit for just COVID finishing. I mean, anyone could do that. I mean, hey, I'm making more money. I'm a brilliant CEO now. Well, what you done? Nothing. COVID just finished, so now everyone's come back and now I'm making more money. Oh, well, brilliant. Let's give them a pay rise. I mean, stupid, isn't it, really? So there's nothing here. It hasn't improved. It hasn't improved, and I think it's vulnerable to competition. Let's have a look at the profitability score. 48%. Receive positive gross profit. It is, they're making profit. Positive 3-year revenue growth, though. Not good. 48%. That's negative. Sorry, not negative, but it's amber. Return on equity is increasing. Positive free cash flow is good. However, this is what I said here. Positive net debt, not good. It's giving it a score of 50, which isn't that bad. 50 is okay. You know, we've seen companies in bright green and we've seen them in red. 50 is okay. 50 is fine. The business is not going bust. I never said it was going bust. I just don't think it's the greatest deal and the business is booming and everyone should be buying it and it's just fantastic. It isn't. It isn't. It's not the best deal for me so far. All right? So solvency is great. It's not going bust. No surprise. Of course, Disney isn't going bust. It's got loads of cash. Profitability, 48, and I think that's going to that potentially improve over time, but I don't see it happening too soon. Let's have a look. Now then, Wall Street. Now remember, Wall Street are rubbish. Wall Street are rubbish at valuing stocks. They're rubbish at it. They're all traders. They buy tomorrow. They don't care. They don't care about the people who work there. They don't care about how much money you make as a retail investor. They certainly don't care about my audience. They don't care. You know, they don't sit here live every day for free, providing you, information. They are traders. That's it. They don't care one way or another. And they're saying and they also not very good at valuing stocks. In fact, they're rubbish at it when it comes to growth stocks like Tesla. They can't quantify robotaxi, doesn't exist. They can't see into the future. They can't guess. Well, nor can I, nor can anybody else. But however, they don't value what they don't understand. They're just basically following the leader, really. I'm not inspired by anyone who works at Wall Street, if I'm honest. Anyway. The best case scenario, 38% upside. Best case, and we're not in a best case. I wouldn't. What's the point? 38%, I can make 300% on solar. So that's not great. 16%, well, I can just buy the S&P. And that's probably where we are right now. I just buy the S&P and be done with it. I don't need to bother. Worst case scenario, 31% downside. Well, I don't know about that, but obviously, anything's possible, but I don't think it's that bad. But anyway, Competitive landscape, you can do your own research on the competition. I can give you the link to all of this and you can go and check it out at the end. And you might want to look at the margins of Netflix in comparison to Disney, see how they compare, and you can decide whether it's right for you or not. But anyway, I wouldn't buy Netflix either. Disney is unique, but it's not. Again, as I explained earlier, dollar cost averaging is overrated and misunderstood. Doesn't mean you buy a bit now and buy a bit later and just keep buying on the way up as it grows. You work out what your allocation is first and just break it down into structures. If I buy it this, I'm going to buy it more if it goes here or whatever, but not just periodically buy it on the way up. That's not very smart at all. If I felt that Disney would, if Disney went lower from here, I would be all in. If it went down to the COVID levels, I would buy, for me, $5,000-$10,000 would be all in on it. I would buy it there for the parks. That's it, not the streaming services. I'd buy it for the parks, and that would make sense. But where it is now, no, I don't think there's a good deal, honestly. Inside trading. Let's have a look at it. Well, the most recent inside trading was done by the EVP and Chief HR Officer, who sold $85,000 worth of Disney, which is nothing, back in August of 2023. That's insignificant buying. There's no selling either, but there was no selling at Virgin Galactic either, because everybody who's in is in, and like Richard Branson earlier said, you're not buying anymore. It doesn't mean it's a bad sign that no one's buying. You need to understand the sentiment behind it. It was sold 9 to 12 months ago. That was significant. Robert Brent sold 118,000 and 120,000. 6.2 million was sold back 9-12 months ago, but that's not happened, or since February, January and February. That's not significant either. So there's no real worry from an inside trading who's buying and selling at all. If we look at the short interest, there's no real short interest here. There is some, but over 20% is excessive. That's when you start talking about short squeezes. But again, context before everyone gets excited. 100% is when GameStop did its massive rally. Okay, so 1% is it is a short interest. It is noted. It's not anything to be concerned about. But there are companies that are much lower than that. 0.5%, for example. I think Apple or whatever it might be. So 1.16% is, some people think it's going to go lower, as I do actually. So there is some short interest, some short pressure, but there's no short squeeze. There's nothing exciting, nothing like that to think about. But there is some short interest. Again, I think there are people like me who think it's going to go down. But I don't ever short a stock. I never would, never have, never will, and so on. Right, we do have some news here. Now, later on, you will see my reviews here. Alpha Spread cherry-picked reviews, whereas all my reviews, all of them, every single one, for every single stock, appears here. So by tomorrow, if not the next day, you will see my review here, right at the top. Yes, at the top because it's the latest, but not because of that. They report all of mine because they're real, honest, and open. I'm not sponsored by anyone, including them, to say it. Let's have a quick listen in here, and let's have a quick listen to this review here. Here we go.
Dividend and payment and return of its dividend to shareholders. And this is happening for the first time since January of 2020. The company suspended the dividend during the COVID-19.
We're going to talk about the dividend in a moment as well. As I explained right at the beginning of the video, that I'm going to explain the dividend for this company. It's very important because a growth company has to have growth, real significant growth. If it doesn't have a dividend stock. It tends to be a slower growing stock, but we'll cover all that in a minute. But anyway, let's listen into this.
19, well, the media giant will be making the payment of 30 cents a share to shareholders in January of next year. Now, this comes after Nelson Peltz's Trian Fund Management is moving ahead with a proxy fight at Disney. The activist hedge fund saying in a press release on Thursday morning that Disney extended an offer to Trian to meet with the board, but turned down its recent request for representation, including for Peltz himself. For more on Disney's battle with Peltz, we're joined by Doug Kreutz. He is a TD Cowen's Managing Director of Media and Entertainment. Doug, it's great to see you here. So I'd love first just your your viewpoint on this return of the dividend and this pressure that Iger continues to remain under here from Nelson Peltz, whether or not maybe some of the moves that we have seen or decisions announced in the last couple of days, that's really going to do anything to change some of the mood and sentiment around Disney stock.
Yeah, they had previously announced that they were going to institute a dividend, and they did. You know, their cash position is much better than it was in sort of the depths of the pandemic when the parks were shut down. So there was, no good reason for them not to go back to paying a dividend. I don't think that has anything to do with Peltz. They did change some of their proxy voting rules as well. That is a little bit more of a reaction to Peltz. I think in general.
Again, like we just mentioned earlier, you get the headlines about we're doing this, we're doing that, the business is great, but all it's done is returned to where it was pre-pandemic. That's all this is. Bob Iger does not deserve a round of applause. He pays himself way too much money for that. He can, he pays himself an award as a CEO, one of very highly paid CEO. What's happening with the dividend, getting it back, and this efficiency is not someone doing a great job. It's just natural what's happening, and it doesn't deserve any. The stock doesn't deserve any extra, investment because of what's happening. What's happening would have happened if Bob the Builder was running the company right now.
Although I don't know that they feel a lot of pressure from Peltz. He can make noise, but at the end of the day, I think he has less than 2% of the vote. I don't think shareholders in general, while maybe some of the shine has come off of Bob Iger in his second stint, I don't think shareholders really want to see him go, and I don't think in general they think that Peltz has anything to add to the conversation.
Okay, and so of these activist campaigns, what should investors then continue to expect? What kind of weights do you think that they'll continue to give them, as Disney right now really has just kind of bounced off of some of those lows? And of course, we've seen it be able to move to the upside with some of the broader market activity over the past month in November. But at the same time, it's still a ways off of where the company had been in some of its year-to-date highs.
And before he answers that, I agree with that. It's not. The sentiment is not good right now, and the dividend payment is not going to help at all, because I think there's 10-20% left for this stock to drop, and so we're talking maybe like $15 a stock. Who cares about 30 cents? It's a good headline grabbing, and look at me, I'm a great CEO and I've given everybody their dividend back. Yeah. I mean, 30 cents when the stock can drop $15 isn't an incentive to me.
Yeah, Iger came back. He cut a lot of costs out of the business. And now he's sort of identified the need for Disney's content engines to start being successful again. They've had a very soft run at the box office post-pandemic after having had an incredible...
I don't think the CEO actually cut the costs and trimmed it down. All he did was be in the seat when they're losing less money because the parks are open. That's when he came back. I don't think it's that great. And to say that the CEO saved them all this money and he's a great bloke. I mean, again, a lot of, pat your mate on the back. And it's just, as an investor, I'm looking for the actual numbers and the facts, and that's not true at all.
Incredibly strong run pre-pandemic. Some of that's just reversion to the mean, but I think that there's been some specific issues at some of the studios that he needs to address in the two plus years that he has remaining to get them back on better creative footing. And again, I don't think external activists have anything to add to that.
Doug, when it comes to some of the headlines that Bob made at New York Times' Deal Book Summit earlier this week, he talked about some of the discussions around the TV side of the business, whether or not those assets he views as valuable here for the company, kind of turning around and saying that, hey, he thinks it actually makes sense for Disney to hold on to these assets. Is that something that you think is critical when you look at the future of Disney and what this company is going to look like 5-10 years from now?
Yeah, he's kind of gone back and forth on it a bit. I think his current position may reflect the reality that even if he wanted to sell those assets, and I'm not sure that he does, there may not be a lot of buyers for them right now. Like, nobody really wants to invest in linear television assets right now, including...
That's exactly what I said right at the beginning. And remember, I'm doing this live. I didn't know what he was going to say. No investor, gamblers, some retail investors, just follow YouTube channels. Yes, but they're insignificant to the movement of a stock. No institution. I certainly do not want to be buying any streaming service. There's absolutely no point. They're all overbought. That we don't know where it's going. And I would only buy Disney if it went down another 15-20% and just buy the park business. That's it. Everything else is of no consequence to me at all.
General investors, like all these media stocks, are trading at very low EBITDA multiples. The future of linear television is very much in question, at the same time as the level of profitability of streaming is also in question. And with that much uncertainty, there's just not really any reason for anyone to step up and say, oh, yeah, I'll take those assets off your hands. I don't think anybody would really think they could run them so much better than Disney's run them that they could, squeeze extra profitability. So I think right now, whatever he feels inside, he's stuck with the assets and he has to do the best with them that he can.
He's also going to have to figure out when this company is going to start communicating to the streets, to some of the investors, as well as those who just cover this company, what new leadership can look like. And at that Deal Book Summit also talked about and confirmed that the succession process that I believe he said is very robust right now, and looking to retire at the end of his contract in 2026. Something that we have heard and discussed time and time again. But is there a front runner at this point that's started to come to light from your perspective, Doug?
Yeah, I feel like we've been talking about your succession plan for 10 years now, because we have. Look, I think generally up until a few months ago, I would have said they're almost certainly going to pick someone internal. And
okay, I think we'll move on from there now. There's nothing really adding that I didn't already know about. So let's move down here. We've got the dividend to talk about and the back test. Let's find. We talked about the inside trading and the short position. If we look at the last 90 days, we can see the last 90 days was 53% was positive news. Now we use this software here, which finds all the news, can tell whether it's positive news or negative news, brings it all together, gets reviewed, and it gives us a score, and we can see the sentiment of the stock. So the last 90 days, 53%. Last 30 days, 58%, improving. The last 7 days, negative news has grown to 19%. And today, we've got no negative news, really. We've just got all positive and a tiny bit of neutral news. Okay, sentiment's okay. Now then, let's finally, before we finish this, I will give you the link for this service in a moment. Let's go and show you what we were talking about earlier with the dividend payouts. As you know, it was halted, and now it's been reintroduced. But let's have a quick look at it, and we can see here back in 2006, it was 31 cents. 35, 40 in 2011, 60 cents in 2012, 88 cents in 19, 2020, in 2020, it was 88 cents, and then it dropped off, nothing at all. Now it's back at 30 cents. It got as high as 88 cents. It was increasing. We have gone back to what it was below in 2006. If you look at their history, again, information is knowledge, knowledge is power. You will see the dividend has gone back to is 30 cents. I actually, think that's terrible. If you're trying to entice long-term investors back into the stock, how can you give them a dividend that you paid them less than in 2006? It's not a good, I wouldn't even have done it. I wouldn't have even done it. If I was running the company, I'd make the company profitable, and then I'd wait until I could afford a dividend which picked up where I left off and was 89 cents a share. Not 30, where it was in 2006. You can't use COVID as a negative there, can you? So that's really bad. That's a bad advert. Remember, a dividend is used to encourage people to hold their stock and a different style of investor. So I wouldn't touch it for that either. Now let's go back. Let's look at a back test. We can see if we put $10,000 into the S&P and $10,000 into Disney, you can see Disney is actually in the red. It ran away ahead, but then of course it crashed through. It crashed through COVID. It's now down, but it's growing at about the same rate as the S&P. So it's not catching up, like I showed you earlier. It's not growing anymore. It's not accelerating its growth. It's picked up where it's left off. It's offering you a dividend payment lower than you bought it, than you had it originally in 2006. We've got other issues around the stock. It's definitely not a buy for me. I would just buy the S&P. I would be a customer, watch the Disney films. I would go along to the park. But really, quite honestly, it's not the best investment for me. I don't think that Bob Iger has done a great job at all. He's not saved any money. He's not offered a great dividend. He's getting into political arguments. He upsetting, Elon Musk. Whatever, getting called out on TV like that. I'm not going to advertise with you because you made a tweet, which I don't agree with. I think it was a big, huge mistake. It's gained Elon Musk more fans, and I don't think it's done him any good at all. You should never, ever get, if you're Mickey Mouse and Snow White, what are you doing getting involved in political wars like that? He said he didn't, but he did. By going, I am not advertising with you anymore. That's exactly what he did do. Anyway, there's my thoughts. There's my review. It's open. It's honest. It's unbiased. Disney is not a buy for me. Would I buy it? Yes, if it goes to $60. Otherwise, no. I'm looking for the best deals. If it doesn't give me the best deal, I don't buy it. And as what's his name? George Clooney says in Perfect Storm, the fish will gather again for the Andrea Gale. The stocks will gather again for Martyn Lucas. It's not the right price for me. There's better opportunities out there. I'll be a customer, but I'm not an investor. If you want the links to my alpha spread, all my members get a lifetime discount, and you'll end up getting my membership for free. If you look below the description, there's also information down here as well. You can go and check that out. Over here, I'll put all the reviews for all the stocks I do, the full playlist that I do over here, and more videos I think you will find useful. This was done for one of our members. I make this whole movie, whole film for my members. It's a free thing, a gift to you that I do for you if you request it. Until next time, as always, take care of yourselves and each other.